Hey, hello everyone, and thank you for joining us today for this webinar on what is shaping the backdrop for credit risk in 2026. I'm Jo Lott, Head of Credit Risk Training at Fitch Learning, and also I sit on the GCC Syllabus Committee. It's my pleasure to welcome you all today. We're delighted to have Cedric Chihab, Chief Economist at BMI, as our speaker for today. Cedric brings a wealth of experience in macroeconomic strategy and country risk analysis to today's discussion from his base in Singapore. So thank you for joining us, Cedric, so late in your day. Welcome to the Global Institute of Credit Professionals. We're looking forward to hearing your view on all things macro and geopolitics related today.
Well, thanks for inviting me to speak. I thought that was a very, very flattering introduction.
It's our pleasure, Cedric. We need to know what's happening with macroeconomics and geopolitics so we can understand what that means for credit. So you're very, very welcome, and we're really looking forward to your discussion. Let's make a start with our first sort of topic area. I think it's good to set the scene at the beginning. So before we jump straight into geopolitical risk, which I imagine is quite close to the top of most people's agendas for today, should we just start to talk about the broad outlook for growth, just to set the scene?
Sure, absolutely. So last year, 2025 was really, we could say, you could describe it as driven by huge economic volatility with forecast revisions changing earlier in the year because of recession fears, because of trade policy, etc. This year, we see much more stability in terms of economic activity. So last year, growth probably came in around 2.6, 2.7. This year, we think it's going to be there about the same 2.8-ish about. So broad stability. And that's predominantly because we're going to have less trade uncertainty. Sure, there's still going to be some trade uncertainty, but much less compared to last year. At the same time, we have some fiscal stimulus feeding through in the US, China, and Germany. We also have a ton of monetary easing, which has happened already last year, and it's feeding through this year. We also expect some more interest rate cuts by the Fed. We have a lot of CapEx going on, and that's not only AI-related CapEx, it's CapEx related to the commodity cycle as commodity prices have been going up, but also towards industrial policy. So the US and other economies are really driving industrial policy. That leads to a capital deepening, and that's going to feed through to the numbers. And last but not least, we have strong corporate profitability, where we're seeing corporate earnings perform quite well. And so companies are really are doing well. Even small businesses, which had been struggling a little bit before, are now doing better.
So thank you. So a bit of a better outlook really from a credit perspective compared to the previous year. We like that stability as credit professionals. We like stability. We don't like volatility or unexpected shocks. And we kind of like, steady progress, I think is probably the best way to put it.
Sorry, I think what's interesting is you're going from a volatile economic environment to a little bit more stable economic environment, but more volatility from a geopolitical perspective.
Which we will come on to shortly. Excellent. So shall we just do a little bit more digging into the macroeconomic story in terms of the economies that you think might see, fare better, and those that we need to watch a little bit more closely?
Sure. So I think one economy which is really important to watch, of course, is the US economy. It's the largest economy in the world, but it's also one economy that seems to be growing a little bit above trend this year. So we forecast that growth would have come in about 2.1% last year, and that's going to accelerate to 2.3% this year. And that's really driven by a strong consumer, a lot of CapEx related investment. And so it's strange to say, but last year everybody thought the US was doomed. US exceptionalism was over, but US will be outperforming this year. Spain will also be outperforming at around 2.3%. It's slowing down, but it's still, one of the fastest growing economies in the Eurozone. And Germany won't look that great, but it'll definitely see a pretty decent acceleration to 1%. So that's big given how the German economy has struggled over the past few years.
Yeah, I think we've had a few worries about Germany from the credit side, given its, past historical performance. So it's good to hear that, there's some more positivity there. Great. Thank you very much.
That's a lot of fiscal policy feeding through this year.
Yes, of course. Yeah. So there are still quite a few risks we need to think about, though, aren't there? And as credit people, we always have our fingers on the button, looking out for the risks there on the horizon. So you have mentioned a few, but this story that you've painted so far, which sounds fairly positive, are there any things that you think could derail that we should be aware of?
So I do paint a little bit of a positive story in terms of growth because, as I mentioned, developed markets are going to do well. Emerging markets are also going to do well. So especially those in Asia, India, Indonesia, MENA. But there are a ton of risks that investors need to be worried about, and it's strange because any of them could potentially derail what is potentially an otherwise interesting economic outlook. So if you get sticky inflation, either because of the tariffs or feed through from commodity prices, that could lead to elevated bond yields, and that's problematic from a financing perspective and also as a credit investor. The labor market in the US is still showing kind of signs of weakening at the edges in certain parts. So we're not out of the woods there. Once the labor market cracks, or if it cracks, and typically it's a really bad sign. We have a lot of geopolitical risk in the Middle East. You get an oil shock, that could be quite messy. Inflation pass through, uncertainty, etc. With Trump as the president of the United States, most powerful country in the world, his volatile policy making and kind of strategy leads to a lot of geopolitical volatility. Even if the end result is the same as it would have been before, the process to get there is often so volatile and difficult for investors. Then some other things which may be lower risks in form of military clash. If everybody's spending more on defense, if everything looks, if all you've got is a hammer and everything looks like a nail, I like to kind of use that analogy. And then, the other thing to think about is we've been talking about a bit of an AI bubble. We can talk more about it, but if there is an equity market crash, this is important because equities now, just the market capitalization is so high as a share of GDP that any decline like 20, 25, 30%, the wealth effects are larger than they would have been, 20 years ago.
Yeah, and that's definitely something that we're watching. Just going back to your point about policymaking and Mr. Trump, I learned a new acronym that came out of Davos, FOMT, fear of messing with Trump.
No.
So not FOMO anymore, but fear of messing with Trump, because
Probably
nobody wants
that.
to be on the receiving end. I quite like that.
He probably likes that too.
Yeah, that's great. So the first one on your list really was inflation. So let's dig a little bit deeper into that, if you don't mind, because that's something that we really think about from a credit perspective. Do you think inflation is now under control? And in terms of the cycle, the easing cycle, where do we sit? What's your thoughts?
Inflation's still a little bit sticky and definitely above the 2% target for many developed markets, but it has been relatively stable. And it is much, much lower than what we saw in previous years. So it's not that much of a threat. So those supply side shocks that had hit quite heavily have worked their way through the system. And also demand is kind of strong, but it's not as strong as before, as the economy was recovering from COVID. But ultimately, we think that inflation in the US in particular will continue to ease from about 2.7% now to closer to about 2.3 by the end of the year. And that's because of 4 trends. So the first one is the base effects from tariffs will basically skew inflation lower by the end of the year because the tariff increase was late last year. So it'll feed through positively in the year-on-year perspective next year. Have a softer labor market, which means that wage growth is subdued and the pass-through to services inflation is not as bad. Rental prices are starting to come down. And remember, these have a lag because of the way contracts are written every 1 or 2 years. And shelters about 35% of inflation in the US in terms of the weightings. So that's very important, and it has been a lagging indicator. And then the last one is energy prices in terms of oil. Oil has been a little bit kind of supported in recent weeks by the protests in Iran. But ultimately, if Trump tries to flood the market with Venezuelan oil ahead of the midterms, then oil prices come down a little bit. And lower oil prices are, of course, very good for inflation expectations and keeping them anchored. So, those are the things we're looking at. Of course, you could see upside surprises. So tariffs, commodity prices, particularly around electricity prices in the US or gas prices. And that's related to kind of weather disruptions or cold snap, data center demand. So we're still looking at things that could push up inflation, but certainly we're more comfortable with where inflation is going now.
Yeah, and I think the tariff ghost has not gone away, right? given what we saw with Greenland, that could still be used as a bargaining tool, if you like. So we still need to be alert to the fact that there could be some surprises on the tariff front.
Absolutely. Although I would say it might at this point be more bark than bite, just because Trump has the cost of living issue in the US as he heads into the midterms. And he knows, of course, tariffs raise prices a little bit, not too much, but he wants to avoid anything that increases prices. And that's why he walked back on some of those tariffs from Latin America, agricultural products, etc. So he's still going to use it to the tariff stick to kind of beat people on the head who he's not happy with. But I think the threat is diminished as we head into the midterms. I think it picks up after the midterms because he has less to lose after that.
Yeah, we'll probably come back to this in our section where we talk about geopolitical risk, but there's just a couple of other things I'd like to touch on before we do move there. So let's talk a little bit about the Fed. So what's happening at the Fed, and who do we think, or who do you think might be the next chair?
So a lot of things are happening at the Fed.
I know.
More so than the Fed wants. In the sense of you have personnel change, you have a tax on the Fed, you have an interest rate policy. So essentially, from a monetary perspective, monetary policy perspective, we think the Fed will cut about twice this year. So 225 basis point cuts to 325. That takes it potentially to, well into neutral territory, we think. And, it's going to be balancing that inflation and unemployment trade-off, really. But we also see scenarios whereby the Fed might decide to use its balance sheet as well. So, for example, if they find that they can't cut interest rates too much, just maybe because inflation's a bit sticky, and that's fine. They just say, okay, we're going to ease financial conditions a little bit by leveraging the balance sheet a little bit, not leveraging it, but buying a few more, using the balance sheet to buy assets. So it could be securities, could be longer term debt, just to push down yields across the curve a little bit and improve kind of financing costs, affordability for mortgages, which track, of course, long-term yields. So those are kind of the two from a policy perspective. That's what we're expecting over the next few quarters or so.
Okay, great. And votes for the new role at the Fed?
Yeah, absolutely.
Who are we thinking?
Yeah, you asked me who I think. I have no idea because whatever goes on in Trump's mind, no one has any idea. Probably not him until the last minute. And you can actually see this from the different probabilities. So you had the two Kevins in the race. Yeah, Kevin Hassett, who was leading for weeks, if not months. Then Kevin Moore started to lead. Now Rick Reeder from BlackRock is in the lead. So what's interesting is Bessent basically said they're looking for someone like Greenspan to be flexible and basically allow maybe monetary policy to be cut a little bit more despite strong growth, because the view of the administration is the US economy is going to enter a productivity boom, and that means that you can have higher growth. And so you don't have to be too worried about higher growth because your capacity constraints are essentially expanding as well. I think the bigger question of, past kind of the next Fed chair was really the independence of the Fed, right? Because Jerome Powell got, served with subpoena that raised questions about the Fed's independence once again. Now, of course, Trump walked back very quickly by saying, no, we're not looking to fire him. And Scott Bessent, he basically said, oh, we were surprised that happened. But, these are lots of different attacks on the Fed through different manners. So, for example, you have Lisa Cook, right, who's also there's a hearing in the Supreme Court about whether if Trump is able to fire her, etc. So in that sense, kind of the independence is a big question. We think that essentially the structure of the Fed makes it less prone to political meddling. So the next chair has to be essentially approved by Congress, by the Senate, right? They have to have congressional hearings. And also, if you have someone like Rick Reeder, who's a markets person, you have Scott Bessent, who's a markets person, no one in their right mind is going to destroy the Fed's independence, right? Because they know that the Fed's as an institution is so important. So if you have a very market-friendly person going on to the Fed, that's actually good.
Yeah, great. Thank you very much. So staying with the US, we can't really not have a session on macroeconomics without talking about the good old dollar. Because there have been some interesting movements, haven't there, in recently with the US dollar and, as you said earlier on, and the Japanese yen as well. So maybe if you could just give us a little roundup on the currency front, and then we can move to another topic.
Yeah, absolutely. So it's interesting because since about last April, May, the dollar's been trading pretty much between the dollar index between 95 and 100, and it's a wide trading range, but it's been quite disciplined within those bounds. Most people have been quite bearish the dollar, of course, because of the large correction early last year, which was quite surprising. We think the dollar trades a little bit sideways from here, but ultimately, over the past few days, what we've seen is a big repricing in the dollar, about 3% move thereabouts, and that was on the back of potential kind of the strengthening of the Japanese yen, possibly on the back of some intervention as well, and also concerns around U.S. geopolitics, etc. And so, in that regard, the dollar now is kind of under pressure, and people are all the dollar bears are coming out of the woodworks now saying, oh, bearish dollar, bearish dollar. And I kind of agree. Look, we just, our view has been the dollar's going to trade sideways because there's some bullish factors, there's some bearish factors. And ultimately, it's going to break one way or the other. I don't think it's exactly clear right now. And while there are some kind of bearish reasons to be bearish for sure, I think you can't rule out some positive things that could push the dollar a little bit higher. So we're kind of waiting and seeing a little bit, but for now it's the sideways trading. I think, for example, if you have a real rising concerns about kind of the Fed, then that's very dollar negative. If you have potentially a growth surprise out of Europe on the upside, that's kind of dollar negative, even though it doesn't necessarily mean the US is in bad shape. It's just better for the euro. If you have new currency intervention in Japan, that's a little bit dollar negative. So those are kind of the things we're watching over the short term. One thing I would say though is it's hard to see, let's say, the euro appreciate by another 10%, because don't forget, it's very export-oriented economy. It already weakened by about just around 10% last year. It got hit with 15% tariffs, so its competitiveness is getting hit. If it were to strengthen by another 10%, I wonder how good that would be for the economy.
Yeah, I was going to say we need to put in the euro as well into this discussion. It's kind of significant factor in there as well. Great. So thank you very much. That's a lot to take in. So everybody who's watching us might be taking frantic notes at this point, Cedric, because you shared so much information with us, all of it so topical. So there is going to be a recording of this session available. So viewers, you don't need to scribble down everything that Cedric has said just to keep up. Let's just try now and move focus a little bit, slightly different, onto credit markets. Okay. So you did mention a little bit about bond yields earlier in the discussion. Bond yields have also been behaving in a bit of a strange fashion. We talked about the Japanese yen. Japanese yields have risen sharply also in recent weeks, and the long end of the US curve is still quite sticky. So as investors or as participants in the markets, how should we be reading this? What are the markets telling us?
Yeah, that's a really good question, because as you mentioned, the long end remains elevated across the board. Some are rising, some are just not falling. And I think there are four reasons why this happens, right? So one of them is kind of a more positive repricing of growth. Two, potentially expectations that inflation are rising over the long term a little bit. Three are fiscal concerns because of wide fiscal deficits and high debt levels. And then four, just risks, right? Uncertainty around trade, uncertainty around Fed policy. And, we think the term premium remains elevated in the US because it's a combination of fiscal risks as well as broad risks. Yes, there might be a little bit more growth from productivity, but I don't think investors are really signaling that. So ultimately, the long end, the whole curve should normally shift down as a Fed cutting cycle enters more, you get more momentum there. So the long end, the short end comes down, the long end also comes down. But what we've seen this time around is the long end remain quite sticky. And that's because of the factors I mentioned. And in Japan, what was quite interesting is you had a big move in bond yields last week, in part because of a combination of much wider fiscal deficits expected because of the supplementary budget, and also concerns around maybe political uncertainty as snap elections were called. So investors became a little bit unnerved, perhaps. And I think the sell-off in bond yields in Japan also spilled over a little bit to the US. So these markets are connected.
Thank you. And so taking that sort of political risk element, we're now going to start talking a little bit more about geopolitics, which I'm sure is the main attraction for a lot of people who come to listen to you today, Cedric. So we've had a lot going on in the geopolitical space, and it's been going on now for a period of time as well. Some of these risks we're expecting will still remain. Do you want to give us just a general roundup and then sort of choose a couple of themes that we can dig a little deeper into?
So in terms of geopolitics, the obviously we've had a lot over the past few weeks. So you had the capture of Nicolas Maduro in Venezuela, you have the tariff threats, you have risks in Iran with the protests really becoming very violent, and you had kind of Greenland as well. And of course, in the background, you have Russia, Ukraine. So these are kind of the bigger geopolitical risks that are happening in. The thing I want to kind of frame is we're actually living in a very kind of different world. And I've been telling a lot of our clients that you have to look at everything that's going around the world from a regime change perspective. And what I mean by regime change is every decade, every few decades, regimes change. And could your political regime changes, your fiscal regime changes, right? Financial regime, QE, monetary easing, for example. And what we've seen in the 2020s is essentially an accelerated pace and a much more aggressive pace of regime change across geopolitics, domestic politics, demographics, technology, currencies, monetary policy, fiscal policy. And all of these things are happening at the same time. And from a geopolitical risk perspective, what we're seeing is the real emergence of multipolarity. So before we used to talk a lot about a unipolar world or bipolar world, but now we're getting to a world where it's becoming more multipolar. And when it's more multipolar, then you're going to have more cracks because there's more, not necessarily conflict, but more tensions between blocks or powerful blocks. And I think you're starting to see that more and more. So we're in the early days of this multipolarity where you have the spheres of influence, which are becoming, think about it like tectonic plates. When they clash a little bit, they create huge movements in the Earth's surface. That's how I think about it from a geopolitical perspective. And this is going to have a big impact on how we think about kind of global financing, global currency regimes, institutions, right? So, for example, the US is pulling away from traditional institutions built after the Second World War, whereas China is trying to build new ones to complement the existing ones, which give BRICS nations and emerging markets a bigger voice. So it's not as if this is one thing, this is many things. And a case in point is Greenland is basically a change to an America First policy where they are hyper-focused on national security and international security, and are to become somewhat paranoid because they think that China's rise and Russia's rise with China to a degree in terms of military partnership poses a huge threat to the United States, and that's why they're also pushing NATO countries to spend more and pushing Europe to spend more. So sorry if it's a little bit long-winded, but that's kind of the geopolitical environment we're looking through, and I think there's a potential risk for Iran to kick off again. So we know that Trump is sending kind of warships to the Middle East, and we don't know exactly how that's going to play out. But if it results in a resurge of protests, maybe the government falls. If you look at betting markets, it's pointing to it was pointing to a few weeks ago very like a 50% probability that Khamenei would be out by the middle of the year. So a lot of potential for regime change in the Middle East as well.
Yeah, and all the ripple effects that will then cause that we need to be watching out for. Thank you. So it's not only just the sort of geopolitical international landscape that we need to be looking at, but also domestically. We need to be focusing on things like US midterms. I know you've mentioned them already. Anything else we should be focused on from a more domestic political standpoint?
Yeah, absolutely. So the domestic element is really important to think about because the domestic economies face very challenging political constraints. So if you think about some of the policies in the UK or Spain, where governments, they're not very strong in terms of their majorities, right? They find policy making very difficult. And I think that's really important for an investor to think about. Or France, for example, there's a great case in point for credit investors, whereby the government is so weak they can't make the difficult decisions. And if you can't make difficult decisions, you can't cut spending, for example, right? Or when you're forced to spend more on defense, you can't cut elsewhere, which means it creates a kind of different type of risk perception for investors. So the things I'm looking at, of course, are elections. The election cycle is very big for emerging and developed markets. So we have presidential election in Brazil. That's going to be a big one this year. I mentioned some snap elections in the lower house for Japan. I think we have some presidential elections in Peru. We have elections in Bangladesh. So lots of political events happening in emerging and developed markets as well this year.
Yeah. And just to touch on what you said about, the defense spending, or just, higher costs in general, that all has an impact on sovereign debt levels as well. So when we talk from a credit perspective, we're thinking about how much debt is sustainable. Are there any countries that you're particularly concerned about from an increasing deficit or debt perspective?
So I would say that developed markets are starting to look like what emerging markets looked 20 years ago. And emerging markets have done a much better job at keeping a lid on debt. I think it's important not only to look at kind of government debt. I know from a credit perspective, we do that a lot from a rating and sovereign perspective, but I like to think about it in its totality. And because when you go through a recession, sometimes that private sector debt ends up on the government's books, right? So it's very important to also look at the private sector. And if you look at that, actually, you also see some interesting things. So if you just look at government debt, it's clear developed market government debt is much higher than emerging markets. And emerging markets have done a fantastic job over the past 15, 20 years or so. But if you look at overall debt in aggregate, actually Chinese debt load is close to 300% of GDP if you include government, households, and private sector businesses, compared to the US, which is around 250. So you start seeing some really interesting dynamics when you add the total debt together.
Yeah, looking into the numbers is key, not just taking what you see on the surface. So that's what we teach to our credit analysts. And I've been learning all about that all through my career. Don't just look at the surface numbers, do dig deeper and see what's going on underneath. That's great. Thanks very much, Cedric. So we talked a little bit about debt markets. Let's move on and think about commodity markets. So you have mentioned the oil price, but what do you think are the impacts, a bit more specifically maybe, of the sort of geopolitical landscape on commodity markets?
Yeah, so I think there are different ways to look at it. So clearly gold is benefiting and precious metals is benefiting from that geopolitical risk. So there's the sanctions on Russia. And so there's a move to change your reserves from the dollar, which can be sanctioned or seized, to gold, which you hold in your vault. So that's one driver. But interestingly enough, gold has underperformed other precious metals like silver, palladium, and platinum, which tells me that in addition to that geopolitical risk element, there's a huge industrial demand element, right? I mentioned industrial policy before. So for example, silver, widely used in solar panels, etc. So you've seen, now obviously, silver market probably has gotten well ahead of its skis. It's basically gone vertical. And so maybe, it's well ahead of its fundamentals and there's a lot of speculative activity there. But what I'm trying to say is it's not only a question of geopolitical risk, it's a question of uncertainty. It's a question of industrial demand through this industrial policy, which has really taken shape. Now, when you think about the commodity complex more generally, you have these commodities which are certainly good for emerging market exporters. So in South America, you have the copper exporters, gold exporters, through Chile, for example. In Southern Africa and Sub-Saharan Africa, you have a lot of gold and commodity exporters, South Africa, of course, being one of them. But it's also interesting to see that even though some commodity prices have gone up quite a bit, energy prices haven't gone up as much, right? Trump is trying to keep a lid on energy prices. And that has kind of created a very interesting scenario where your oil producing economies aren't benefiting from the huge run up in prices, but your other emerging markets, which may be energy intensive because of the mining and extractive industries, but rely heavily on oil imports, they're going to be doing better. So that's quite interesting if you look at it from that perspective.
Thanks. We have got a question in the chat on exactly that topic, actually. So I might just bring it in now just because it's so timely. So the question is, what is your view, excuse me, on continued low oil price and the impact on the global economy, balancing between the oil exporting and the importing countries?
So I was alluding to that question actually. So even though oil prices have not risen sharply, like copper, gold, for example, nickel, I think what's interesting to note is that we still see growth in some major oil producers just because they're increasing output, right? So that's a great way to kind of raise revenue, raise export revenue by increasing output. And so if you think about it, lower oil prices in general compared to a few years ago, plus keeping a lid on oil prices is very good for the bottom line for corporate profitability because energy costs really eat into the profit margins and for households. So think about your energy bills in the winter. If the or gas prices at the pump when you're filling your car. So in that sense, it's a good environment where you have emerging markets which are energy intensive in terms of the usage of energy, but their terms of trade basically have improved because what they're exporting, like copper, silver, gold, etc., is rising faster than what they consume, like oil.
So just to sort of take us to the end of this part of the session, Cedric, we just comment a bit about market volatility. I know we've spoken about it and we've highlighted some areas that are particularly more volatile, but we started out talking about the broad outlook for global growth being quite stable. So do you have any final comments in terms of market volatility? And are there any risks you see sort of late in the cycle that we should really be keeping a close eye on? I know you had a chat with your colleagues or our colleagues at Credit Sites to pick up some views from them as well. So maybe you can just touch on that for us and then we'll go to questions. Thanks.
Yeah, absolutely. So volatility has declined from the April highs. So if you look at equity volatility, bond market volatility, and currency volatility, these have all declined quite substantially, and which is of course very good. The problem is things go bad when volatility is too low and investors become complacent, because what happens is people load up on debt, and then that creates a skew whereby when things like you get into leveraged positions, and then when the market moves against you, well, you're leveraged and your losses are compounded. So that's how kind of volatility starts spiking. Now, it's quite interesting. I was talking to Credit Sites earlier today. So they're our sister company. They do a lot of great work on dollar bond issuance and credit market analysis. And their views are essentially that US IG spreads, which are quite narrow, are going to widen to about 120 bits. Currently, they're about 73. And that's just because they expect a little bit of a deterioration in asset quality. They also think that there's going to be higher supply in terms of issuance. And I think, you hear that from the hyperscalers are going to be issuing a lot of debt, for example. So more supply leads to maybe a silent higher yield generally. And so their view is that it's going to be hard for investors to get excess returns. It's going to be quite challenging, but total returns should be okay in general. At the same time, when they look at European IG, that's going to have some mild positive excess returns. So that's kind of their broad view in terms of credit positioning in credit spreads.
Thanks very much. Okay, so on to our questions. So I'd like to just keep on that sort of credit theme. The first one that's come in is we talked a lot about this year for 2026. Do we have the visibility to go a little bit further out in time? So maybe into next year now and talk about, what do we think about the sort of sovereign backdrop, the macroeconomic backdrop and the credit space for 2027?
We barely know what's going to happen next week. But Trump as president asking to look out 2 years is
your crystal ball?
Really powerful crystal ball we need. No, but jokes aside, if we have a relatively strong economic performance in the US, that's good for the global economy. So I think that's certainly a positive. And we're not going to be in a world where you have a huge decline in political volatility, whether it's geopolitical demand, just because of the actors you have in place and the multipolarity that's happening. So this is something that investors are going to have to learn to live with. And I would actually say, before, the world felt riskier than it did before, pre-COVID. So pre-COVID, it felt, with central banks really keeping policy settings very loose with QE, etc. Risk assets were, one direction. I mean, I remember walking into the office with like 18 years ago, and Chinese markets will be down 10% in a day for no good reason, right? So, volatility is actually the norm when it comes to investing. I think we've seen, and of course, we've had a lot of volatility over the past few years, but I think that's just something investors have to get used to, and more and more that. But the other thing, which I think is noteworthy, is the U.S. government is looking to ease regulation on banks at a time when interest rates are coming down, at a time when you have a lot of financial innovation, crypto, new lending, peer-to-peer, etc., and at a time when household balance sheets are much better than they used to be. And so, looking out 2 years, I see the potential for the private sector credit cycle from a household perspective, and a little bit of businesses as well, to pick up potentially as the private sector responds to lower interest rates, the banks respond to deregulation, and they can lend more. And as you find new ways, innovation and growth around credit lending, etc. Now, it doesn't come without risks, because whenever you have kind of a big credit cycle, then the next time interest rates go up, that hurts those more risky borrowers. But if you look at, banks haven't been lending as much as they used to. Households haven't taken on much debt. So I think that's the potential cycle to look at for the next 2 years.
Yes, and that leads us nicely into another question that we've received in the area of private credit. So we have seen, quite a significant growth in the private credit space, and part of that is driven by the banks not having that credit appetite because of their sort of already very high levels of regulation. When we talk about the US sort of dialing back a little bit, but they are still very heavily regulated institutions, and there is still a lot of appetite for credit out in the market. So turning to private credit, we've seen spreads narrowing, we've seen growth, we've seen competition in that market. You've mentioned financial innovation. More investors are getting comfortable in that space as well. And some characteristics that some people, maybe the bears in the market, are thinking might be a bit of a bubble. What are your thoughts on private credit?
So I don't look at this too closely, but
Yeah.
when speaking to our colleagues in credit sites, they think that the kind of the banking sector can manage some of the challenges. And if you talk to our ratings colleagues, so at Fitch Ratings, they published a private credit outlook for 2026. It's a really good summary of their core views. But basically, they don't see strong evidence of a bubble where valuations have significantly stretched beyond what fundamentals would suggest, or where there's too much market exuberance in driving extreme momentum. As you mentioned, there has been narrowing spreads and growing competition, and a widening of the investment base. But in their mind, it's not a bubble.
It's manageable. The only thing, I guess, is we haven't been through the full economic cycle, with that much sort of private credit exposure. And that's the bit you've got to kind of season the portfolio, haven't you? You've got to go through the lows to see how resilient the portfolios really are.
Well, I mean, the challenge is this type of lending is opaque, so you never know where it sits. And if people are thinking, well, remember during the GFC, there was a lot of off-balance sheet debt and this, that, and the other. So when it's not visible, it comes out at the worst moment, and that's I guess what people's memory is kind of reflecting on. But the difference is interest rates are being cut now. Growth is accelerated. So I think conditions, we're not going through a tightening cycle.
Yeah. So we're well positioned. Excellent. Thank you. So just conscious of the time, we do have one more question has just come in, and this is on EU competitiveness. So
Okay.
We've had a report recently from Mario Draghi on EU competitiveness. How necessary are those recommendations to EU growth? And what is the likelihood of that happening anytime soon? I think that means the EU growth, because you mentioned, you said Spain was doing quite well early on, and Germany is better than it was. But what do you think about EU growth and competitiveness?
So there's a meme which I love, which is the US innovates, China imitates, and Europe regulates. And I think that hits the nail on the head, unfortunately. So I think the European Union has a huge competitive challenge ahead. And the Mario Draghi report was really important in kind of bringing it front and center. And we have seen a lot of governments put into place reforms to help address this. But There are structural challenges, right? It's not, it's not the perfect economic union in terms of services and productivity. So there are always going to be challenges, different languages. So the European Union and the EU have naturally some challenges in terms of competitiveness. And so they can fall behind by over-regulating and giving away the edge they do have. So in that regard, I think they have a lot of work to do in the years ahead. And, policymakers don't really agree. So you hear stories about some governments blocking the development of certain technology because the other country is developing it. They want to give it to another. And it's all very, very problematic. But the big challenge really for Europe as well is, you mentioned Spain. One of the reasons why Spain is outperforming is because it's a services dominated economy, which benefits from tourism and hospitality and other types of services. But if you're a manufacturing economy like Germany, you're getting hit. You're getting hit through three different channels. The first one is much higher energy costs, which just there kills your competitiveness and
Painful.
profitability.
Yeah.
Then your biggest market used to be China. China's not growing as quickly. They're not buying as many goods. And, Europe used to be a massive, used to be very competitive in kind of the global market space of vehicles and capital equipment. Now China is knocking at the door, competing head on with even better technology in some cases. So Europe really has to figure out its productivity problem if it really wants to compete economically around the world.
Yep. Great. Thank you so much. I think we have covered all of the questions now. So, Cedric, we are towards the end of our session. Do we have any closing remarks? Anything for our listeners, viewers to take away with them in a nutshell from geopolitical risk and macroeconomics?
I'll just say two things. The first one is just to rehash the view that we're going into potentially a little bit more of an economic stability, but a lot more geopolitics. The second thing I would say is market economies are very flexible and dynamic. So obviously as an investor, it's never good when your investments are down 10, 15%. But central banks are, they've learned a lot of lessons from the past in terms of coming to support the economy where needed. Economies and businesses are very dynamic. If you think about the types of shocks we've lived through since COVID, these have been generational, and markets are touching new highs in equity markets. So, sometimes the market economy performs quite well, even though you have a lot of risk.
Yeah, great. Thank you so much, Cedric. Really interesting speaking with you today. And I'm sure everybody who's on the webinar and all of those people who watch the recording afterwards will agree. And thank you so much for your time and your insights. It's been great speaking with you. Take care, everyone. Thank you for watching. Take care, everyone. Have a good rest of the day. Goodbye.